This systemically important $20 trillion asset class is starting to collapse.
We have to understand that commercial real estate has dropped in value.
The office business faces two significant headwinds. One is a slowdown in economic conditions, and the other is work from home.
Moody's analysts find that nearly a third of office buildings in its top 80 metros could be, quote, obsolete.
How bad is it going to get? I'm going to reveal the answers to you right now in 3 simple, fast steps. Step number 1, let's go over how right now the current situation is much worse than the GFC. We start with a chart going all the way back to 2007 to today's date. On the left, we go from 9% up to 18%. These are the vacancy rates that we are seeing in downtown offices. So you'll notice during the GFC, they got up to right around 14%. Afterwards, they get back down to kind of their historic level, say 10%. But what we have seen lately, as you would imagine, with the cerveza sickness, is they absolutely go parabolic. But what I really want you to pay attention to is this part of the chart, say 2022. This is after the lockdowns. This is pretty much after the cerveza sickness, and you see the trend going in the exact same direction, to the point now where these vacancy rates are over 18%. A staggering number when, again, you consider during the peak of the GFC, they were at 14%. But let's stop for a moment and think through what this really means. What are the ramifications? Well, if the vacancy rates go up, that means the revenue goes down, and it goes down fast. And we know that the vacancy rates increasing most likely won't come back to their historic norm. Why? Well, first and foremost, because this is a trend that we're seeing, work at home, and it's probably not going away. Second is if we go into a recession or an economic depression, which is what the yield curve is predicting right now, you would expect for the revenue for these building owners to go down even further. Oh, but wait, there is more. Let's not forget that interest rates have increased massively over the last year and a half. And a lot of these building owners have to roll over their debt. So if they buy a building with, let's say, 3% debt, and then they have to roll it over 3 or 4 years later at 5, 6, 7, 8% debt, that means that that debt payment is going to be a lot higher, which means that their net revenue is going to be a lot lower. And this is happening at a time when cap rates are going up. So why would a cap rate, and I'll explain what that means in a moment, actually go up? Well, first and foremost, because interest rates of other assets that would be equivalents are going up as well, such as 10-year treasuries. So if 10-year treasuries go from 50 basis points up to, let's say, 3.5%, well, that gives you an alternative to buying a building and getting, let's say, a 4% yield. The risk reward to buy that building doesn't make sense at all if the 10-year treasury is close to the same ROI. So the cap rate, or the ROI, on that building would have to increase along with interest rates in the real economy. But now let's think through how their net revenue going down and the cap rate going up would impact the actual price. So I don't want to get too far into the weeds as far as math. I'm not really a math guy, but trust me on this one. The price of the building, or what it's worth, is basically the net revenue, we'll say, divided by the cap rate. So let's go through some examples. Let's say that you buy a building and it's yielding $100,000 because the vacancy rate, let's say, is 10%. Well, that vacancy rate plummets because of what we have seen over the last couple of years, and the cap rate goes up. Let's say you buy it at a 3% cap, so the value of that building would be $3.3 million. Okay, well, let's say for a moment, we'll back up here, that the revenue that you're collecting is the exact same, but interest rates go up in the real economy. So now the going cap rate, instead of being 3%, is 7%. Well, that means that the value of the building would go from 3.3 million down to approximately 1.4 million. And it gets worse. Now, let's say you take a haircut on that net revenue because of what we've seen over the past couple of years. So your net income, your profit, goes from $100,000 a year down to $50,000 a year, while at the same time, the cap rates go from 3% to 7%. That means the value of that commercial building would go from 3.3 million down to 700,000. And let's not forget, this is playing out right now with a systemically important $20 trillion asset class. So to say this is taking us straight into the no bueno zone is a dramatic understatement. In reality, this could be taking us straight in to the next financial crisis. Step number 2, mortgage-backed securities that triggered the GFC in 2008 are blowing up once again. But this time, it's commercial mortgage-backed securities. Let's go right to a chart going back to 2020. On the left, we go from 0% up to 12%. This is the spread for BBB commercial mortgage-backed securities over 10-year treasuries. This blue line represents BBB corporate bonds. So kind of a reference point so you can see how extreme the moves are with these commercial mortgage-backed securities. So going back prior to the cerveza sickness, right around 3% was the spread above, we'll call it 10-year treasuries. And then, as you can imagine, when the government locks everyone in a cage and doesn't allow them to go to work, the spread rips higher, all the way up over 10%. Then it comes back down, but it never came back down to where it was before. Why? Because it goes right back to those trends that we talked about in step number 1, more and more people working at home. Therefore, the vacancy rates increase, revenues go down, which increases the risk of default on these mortgage-backed securities. But look at what these spreads have done recently. They've gone all the way back up to where they were at the peak of the pandemic when everyone pretty much thought the world was coming to an end. And I'd like to remind everyone, the higher that number goes, the higher the default risk. And if we start seeing defaults with the mortgage-backed securities, in other words, those loans aren't being paid back, it takes us straight into a GFC 2.0 type of scenario. To give you some more reference numbers, let's look at the size of this market. Like we said, $20 trillion, and compare that to residential real estate around $35 trillion. But you may be asking yourself, okay, George, well, I understand that these are commercial mortgage-backed securities, so not residential. What was the spread that we saw on residential mortgage-backed securities during 2008? Well, the highest spread we saw back then was 2%. 2%. And just to make sure we're all on the same page, right now, with these commercial mortgage-backed securities, the spread is over 10%. But the key takeaway from this chart is it emphasizes exactly what we were talking about in step number 1. That is that prices for these commercial buildings are coming down, and they are coming down fast. To dive into the details of these massive price declines, editor, let's go right to the internet. So we go right to a story from wolfstreet.com, titled, "What Are Older Office Towers Worth When They Finally Sell Amid Record Vacancy Rates?" Not much. Huge losses everywhere. And this is no exaggeration. They start off by talking about Blackstone just took a 36% loss on this 13-story Class A office tower they sold in Orange County. But unfortunately, it gets a lot worse for Blackstone and the holders of those commercial mortgage-backed securities. Check this out. 2014, they bought a property for $605 million. Then they borrowed $308 million against it. By March 2022, the value of the property had dropped so far below the loan amount that it was better for Blackstone to basically give the keys back to the people or the entities that owned those mortgage-backed securities. Here's another transaction where they point out the owner took a 47% loss. Here's another one at 37%, 40%, 47% loss again. But unfortunately, it gets a lot worse. Let's get into some of the foreclosure sales of these office towers. Right off the bat, an 88% loss, an 82% loss. And they conclude the article by highlighting a recent transaction where they actually took a 100% loss. These are great examples of this systemically important $20 trillion asset class collapsing right in front of our eyes. Step number 3. Unfortunately, this is a long-term problem that we'll most likely see play out over the next couple years. But the good news is there are things that you can do to protect yourself. We're going to go over that in just a moment. But before we do, let's look at another chart. It goes all the way back to 1975, all the way to today's date. On the left, we go from 0 trillion up to $12 trillion. This blue line represents loans and leases. In other words, bank lending. So we can see it pretty benign, goes up to a point, GFC flattens out, goes down. It goes up even further at a steeper trajectory until we get to the cerveza sickness, comes down again, and now recently it has gone parabolic. But when you kind of zoom out, this chart looks rather benign. Not that big of a deal, especially what's going on right now. Doesn't seem too unusual. But what you have to do is zoom in. And when you zoom in, that's when you see the storm clouds brewing. Let me show you what I'm referring to. So editor, go ahead and throw up this part of the chart that I'm specifically talking about. We can see that the bank lending is actually starting to decline. And it's not just declining. It's doing so at a record pace. To give you some specific numbers, bank lending in the last 2 weeks has gone down by $104.7 billion. Now, you may be asking yourself, okay, Georgia, why is this a big deal in terms of commercial real estate? Good question. I'd like to point out that over the next 2 years, there's going to be $1.5 trillion worth of debt in the commercial real estate market that is going to be due. Well, how does that play out when we know the banks are wanting to lend less? And if we go into an economic recession or even depression globally that involves a banking crisis, or this banking crisis we're living through getting worse, that means the banks are going to be lending less and less and less. And that's going to come just at a time when the commercial real estate market is trying to roll over their debt. So in step number 1, we talked about how the revenue decreases if they have to pay a higher interest rate when they roll over their loan. But in this type of scenario, they might not be able to roll over that loan at any interest rate. There are no certainties. There are only probabilities. But the probability is increasing rapidly to the point where this should be on everybody's radar. So now the question becomes, what can I do to protect myself from an upcoming recession, depression, collapse in the real estate market, or future problems in the banking system? I've got some good news for you. Coming up May 12th to the 14th, I'm holding my annual investment conference, Rebel Capitalist Live. And we're going to have speakers that are going to give you insights as to how you can not only protect yourself, but you could actually profit and see opportunities where others see crisis. We've got speakers like Mike Maloney, Peter Schiff, Lynn Alden, Jeff Snyder, Brent Johnson, just to name a few. So to get your tickets and to check out more details, go to rebelcapitalistlive.com. Now there's 2 other things that I'm doing in my personal portfolio that may help you weather this storm. First and foremost, I own physical gold. And if you don't own physical gold, what on earth are you doing right now? I mean, if there has ever been a time to own that precious metal, it's right now. We've got these economic storm clouds. I mean, let's not forget the fact that we're potentially on the brink of World War III. I hate to even go there. That's just me being realistic. And we're living through a decade that will likely be inflationary. So the easiest thing you can do in that environment is own some precious metal. Next, I've got the largest cash position in my portfolio that I have ever had. Why? Because the bigger the crisis, the bigger the opportunity. And I think that we are going into a long-term super cycle in commodities. Those commodities will likely come down throughout 2023, maybe into 2024. And that will be an opportunity for me to get them at a cheap price, hold them over the long term, and take advantage of price declines that come as a result of this economic tsunami actually coming in and hitting the shore. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, don't go to the next video. Go straight to rebelcapitalistlive.com and get your tickets to Rebel Capitalist Live ASAP.